So thank you for all for joining us today. Delighted to be hosting this Artemis Live webinar with our kind partner, Computershare Corporate Trust today. Now, Computershare Corporate Trust is a service provider active within the insurance-linked securities market in the provision of collateral trusts, and they've got decades of experience in trustee and agency services for the space, and this work extends across the ILS market through collateralized reinsurance, catastrophe bond arrangements, and other areas of insurance and reinsurance as well. Now, today, with the help of our expert speakers, we're going to dive into the state of the cat bond and ILS market at the mid-year point of 2025. We're going to look at activity levels and discuss and get different views from each of our participants from their various industry vantage points. And we will, of course, discuss the renewals, given the time of year, as well as the very active cat bond market, which has certainly been keeping me busy. And I'll ask our expert speakers for their outlooks for the rest of 2025 as well. So I'm delighted to introduce my experienced panel today. We've got Paul Schultz, Vice Chairman, Aon Reinsurance Solutions. Jennifer Montero, the Chief Financial Officer of Citizens Property Insurance Corporation, Steve Velotti, CEO and CIO of Pillar Capital Management, and Michael Alfano, Vice President and Business Development Officer, Computershare Corporate Trust. So welcome all of you. Thanks for joining the webinar today. It's great to have you involved. With all of this experience, rather than go through too many details about each person, going to let their responses to the questions do the talking. And we only have an hour or so, so we're going to get right into it. Now, before we start, just wanted to say that there will be an opportunity for Q&A. We have a Q&A tool in the webinar system, which hopefully all of our participants or attendees can see. And you can enter questions into that, and if we have time at the end, we will get to some of those as well. But to begin, we're going to start with sort of the current state of play, and I wanted to ask our panelists to share some thoughts on the current state of the market in catastrophe bonds and in private ILS from their respective points within the market chain. Michael, I'm going to start with you, and perhaps you could provide a bit of scene setting for the audience and explain the broader financial backdrop we've seen in 2025 so far, and how the cat bond and ILS market's been functioning.
Absolutely. And thank you, Steve, for having me today. There's a lot going on this week, particularly with the G7 meetings in Canada and the Fed's June meeting. So I could have a different answer come Friday, but I'll give it a shot today. So far in 2025, the broader financial backdrop has been shaped by a mix of easing monetary policy from the Fed at the end of 2024, persistent geopolitical uncertainty with the war in Ukraine continuing, and now the conflict between Israel and Iran, along with some shifting global trade dynamics, most notably the potential impact of the tariffs that the U.S. has implemented with higher rates on key imports, particularly from China and key sectors in Europe. And while these measures were framed as protective for domestic industry, they've had the potential for inflation supply chains, adding costs for manufacturers and importers and complicating the disinflationary progress that the Fed had been making over the past several months. And so while the Fed had begun to lower interest rates following their peak tightening cycles of 2022 to 2024, the central bank policymakers have now taken more of a wait-and-see approach to interest rates as they wait for signs of weakening in the labor market or a resurgence in inflation. Officials expressed concern at their last meeting that the tariff hikes could push up prices, and the general consensus for this week is that they'll hold rates steady as they continue to assess how the economy handles the initial months of these historically large tariff hikes. With that said, the market is still cautiously pricing in some rate cuts later this year, likely beginning with their September meeting, but there's still a lot of hurdles to overcome, and that lingering uncertainty has translated into some continued volatility in both the equity and credit markets. And that has prompted many investors to seek diversification through alternative asset classes, including catastrophe bonds and the broader ILS market. And so against that backdrop, the cat bond market has really remained quite robust, as we've seen. And after record issuance levels in 2023 and 2024, 2025 has continued on that same trend. Investors are still drawn to the ILS market for their lack of correlation with the broader macroeconomic and geopolitical risks that are going on right now. And spreads, while slightly narrower than some of the post-2022 highs, continue to remain attractive, and the secondary market has continued to be relatively liquid and resilient. So for cedents and sponsors, the capital markets continue to be a vital source of risk transfer, especially amid growing concerns with climate risk, constrained traditional reinsurance capacity, and the cost pressures that have been exacerbated by trade policy shifts. In short, the ILS space in 2025 has proven itself not only as a diversifier, but as a steady and adaptive component of the global risk transfer landscape amid some very complicated macroeconomic and trade environment.
Great, thank you, Michael. Good overview there of the backdrop that the market has been running against this year, and I think, as you said, the importance of diversification is perhaps even more notable than we've seen in recent years. So no surprise we're seeing a busy marketplace in ILS. So moving on to Paul, it's been a very busy first half for the ILS market and the investor base, and perhaps from your vantage point, you could speak a little about how the capital markets have been building on the strong last 2 years that we've had, and how non-traditional reinsurance capacity from both the bond market and other ILS structures has been helping cedents this year.
Yeah, thanks, Steve, and again, thanks for having Aon participate in the panel today. It's actually kind of a layup question. It's a nice question to get. Things have been going extraordinarily well, and for those of us with enough gray hair or no hair at all, and been around the market for 25 plus years, I think we're kind of seeing what we thought the market would be 25 years ago, and that is having the capital markets provide a foundational part of the risk transfer capacity around property, and as we'll probably talk about a bit later, I think green shoots into some other areas potentially as well. But on the property side, we're now having issuance on a quarterly basis kind of surpass what we were doing annually, probably just even a few 5 years ago. And so things are going just quite well. And really a change, you mentioned the 2 years, really a change since Ian, where I think capital markets were extraordinarily responsive to client needs, both on the bond side and the private ILS side, and as a result, growing confidence to trade within the capital market sector. And as Michael noted, it's a good place for investors to have their asset strategies be part of. And so we're coming together in a way where you've got client interest kind of at record levels, in part due to their growth, in part due just to the response difference between traditional and non-traditional sort of post-Ian. And then you've got very strong investor demand for the product. It's performed well, even with the spread tightening that Michael mentioned. Returns are, over the last couple of years, and I'm sure Steve will talk on it, and so I won't, but returns are extraordinarily attractive to investors deploying their capital. So you've got all these confluence of things coming together. We are kind of developing the market. We envisioned, all of us that were back at that point in time, envisioned this market could be, and really, looking forward, not part of your question, but looking forward, I think all sort of optimistic as well. So I think it's just good amount of solutions for clients, good amount of investor capacity. And what we're doing is what we envision doing, which is matching risk to capital and creating customized solutions on behalf of clients.
Great, thank you, Paul. I like the word foundational, as I think we're really seeing the market having become one of the foundations of global risk transfer, which I also echo your comments and hope continues to build from here. Now, Jennifer, given you're representing the sort of cat bond and reinsurance sponsor or cedent side in our panel today, it'd be great to hear your experiences in preparing for issuances and renewals this year, sort of how the engagement with the ILS market has gone for you, and whether you found conditions in 2025 more supportive and perhaps capacity more readily available for citizens as well.
Sure. Heading into June 1st for the renewals, our strategy was to go out early into the market to take advantage of the positive momentum in the market. We continue to hear from market participants that losses from the 2024 hurricanes, as well as the 2025 wildfires, were manageable for the risk transfer market. In addition, there is tangible improvement in the Florida market as a result of the insurance reforms that passed in 2022. So based on those factors, we had very positive meetings with investors as part of our roadshow, and felt that there was ample capacity at efficient pricing levels of our program this year. Our initial price guidance for the Everglades transaction was $975 million, with room to upsize if the market conditions were favorable. The investor appetite and the pricing in the capital markets was very positive, which is why we ended up upsizing Everglades by 56% to $1.525 billion.
Yeah, it was a really notable deal this year, and I think many of the investors watching will probably be thanking you for helping to absorb some of the capital that was coming available through the maturity cycle in the cat bond market as well. I think these larger deals this year have really helped investment managers in recycling capital efficiently in 2025. Thanks, Jennifer. So
Sure.
turning to you next.
We did have the largest cat bond for 7 days, Steve. I will mention that.
You absolutely did.
7 days.
And if we're counting series, you still have the largest, I believe, so rather than visits to the market. So congratulations on that. And I know the market really appreciates citizens' persistence in bringing risk to investors. Turning to you next, Steve, as you're representing the sort of investor and fund manager side on the panel today, it'd be great if you could give our audience a sense of how the first 6 months have evolved. Maybe touch briefly on sort of challenges the California wildfires might have posed at the beginning of the year, but then also perhaps speak a little about opportunities that have emerged, and also how demand for your capacity has developed this year, perhaps compared to previous years.
Yeah, Steve, thanks for having me and Pillar Capital on. The demand is strong, like Paul mentioned. Just to kind of cover the last topic first, the whole Trump effect is a huge benefit to Paul and I. The more investors get whipsawed around in equities, and tariffs are on, they're off, they're back on. Who knows where they're going to be at the end of the week? Like Michael said, everything we say here might be a moot point in 5 days. But all of that is a positive to the reinsurance and ILS market, at least for the fund space, because we're kind of detached from that. We're not invested in equities. We're invested in T-bills and money markets, and you got climate change issues and things like that you have to educate investors on. But there aren't a lot of things that are kind of detached from the financial markets. And cat bonds trade, and there's a little bit more correlation, but in general, it's a low correlating asset class, and private reinsurance is even less. That's probably only correlating 5%-ish, which is really probably randomness. So from that standpoint, there's been more focus on it. The education process in reinsurance and ILS is much longer. You go into a public pension fund, and there's 5 people who are experts in credit and 5 people who are experts in equities, and if you're a manager in those areas, they're going to know exactly what you're doing. With reinsurance, they don't know, and the jargon is different, and it takes months or years to get these people comfortable with how things work, and then you have the overriding climate change issues that people have their own personal biases on, and you need to try to work through all that. And some folks you can get across the line, and some are just going to believe what they believe, and that's the end of it. But in general, I think certainly there's been inflows into the cat bond space. Private ILS has probably been a bit more flat, and I think part of that is we've had a good couple of years, and returns have been well above average, and people have been trimming off profits. So unless you can get an investor to come back in, you're gonna have some outflows. But no good deed goes unpunished in reinsurance. I can see. So from that standpoint, the market is good, and even though expected returns are down a bit from last year in the private space, they're still probably above average, and investors have still continue to look at this at the space. I think starting off the year with the wildfire loss, and there was significant disparity across different players in the space. You got to kind of put it in perspective. A $35-45 billion wildfire event is a really low probability event. Even if you make a significant adjustments to the catastrophe model, a $35-45 billion event of any kind globally is actually probably a 1 in 3, right? If you take in earthquake and hurricanes, and if you put it all together, if this was a $35 billion Florida hurricane, everybody would have paid all the claims and shrugged, and that would have been the end of it. But because it was wildfire, are we approaching this correctly? And should things be reviewed? And then you got the political issues that get thrown in there with Lara and what he wants to do. That's a whole other wild card. So I think most of the folks have managed it well. I mean, the cat bond clearly came out looking good. There aren't a lot of bonds that cover wildfire, so most of it was held in the private reinsurance or mostly with a lot of the big nationwide insurers. But I think investors are okay with that, and it hasn't really dampened the desire to be in the space. So I think looking forward, again, the Trump thing, people are distracted by that. They can't devote the resources to doing the research. I think it'll be more of a January 1 opportunity, really over the next 6 months, if we can get people to focus on this as opposed to what's being said each week and from political issues. And I think the war really probably doesn't have any impact on the property cat market. It shouldn't be a significant issue. So unless it becomes much more widespread.
Sure. Thank you, Steve. Good to hear about the wildfires, because that's kind of the sentiment I'm hearing from people, is that the investor base seems to have felt the industry dealt with that quite well, which is positive, given it was, as you said, a bit of an outlier event. Great. So we're going to move on to another round of questions, and this time we're going to talk about kind of how the asset class of insurance-linked securities has continued to deliver for its constituents on both sides of the trade through the first half of 2025. And Jennifer, I would like to begin with you this time. Obviously, you're a long-standing sponsor of cat bonds, including this year with the particularly large issuance, but it'd be great if you could talk a little about how you found execution in the cat bond market this year. And also, it'd be interesting to know whether you feel the growing investor base in the asset class is making a difference for you as well.
Sure. So for this year's transaction, we had an order book of over 1.8 billion within the initial price guidance, which is more than 1.8%. I'm sorry, 1.8 times our initial size of the 975 million that we entered the market with. We ended up placing the 1.525 billion because we wanted to stay within the lower end of our initial price guidance, that range. When we look at our investor base, we had 31 investors that put in orders for this transaction. And so we looked back at our investor base for our largest prior transaction, which was the 2014 $1.5 billion placement, and we had 33 investors. And when we compared the two investor bases for the similar these similar size transactions that were separated by 11 years, over half of the investors in this transaction are the same investors that participated in the 2014 transaction. And the average order size is very similar between the two transactions. So as a governmental public entity, we are transparent, and investors trust the quality of our data, which has led to these long-standing relationships with a broad group of investors. In addition, we continue to develop relationships with new investors as the market grows and evolves, and we like to meet with, even if somebody doesn't want to participate with us that particular year, we do meet with as many markets that are willing to meet with us to at least get in front of them and let them know about our program. So we feel that it was very successful. We've been able to keep most of our investors over the last since 2012, we've been placing cat bonds. So we were very happy with the investor base that we had for this transaction.
That's great to hear. That's the kind of consistency that an asset class that's becoming a foundation of people's risk transfer really needs to demonstrate as well. So that's very good to hear. Michael, turning to you, perhaps you could speak to what you've been seeing in the cat bond space and how the growth of that segment is supporting sponsor needs and investor appetites in 2025.
Yeah, and to echo a lot of, what Jennifer said, we've been seeing, an increase in the demand for trust to support these cat bond issuances. And, I believe that that's stemming from, the insurers continuing wanting to move risk to the capital markets, to cover the increase in costs and climate volatility. But at the same time, still having competitive pricing for that reinsurance coverage and attractive demand for those investors, which speaks to Jennifer's point that those investors continue to come back to look for that asset.
Yeah, it's good to hear that there's this consistency in the investor base nowadays. Although I guess the ILS market has had some foundational investors in it for right since the beginning who continue to be some of the leading players. So it's really a sector that's seen that consistency through its lifetime. It's just grown, and more of them are now consistent, returning to the asset class and to the transactions, which is great to see. Moving over to the private ILS segment and collateralized reinsurance, Steve, it'd be great to hear your thoughts on investor appetite and how that's evolved, but also whether you feel demand may be rising again after a few years where the bond product has perhaps taken a bit of a focus for some allocators.
I think certainly demand, certainly interest has increased. Whether you get the people across the line is a different story, because the education process is just quite long. I mean, at least at Pillar Capital, we have over 150 investors. So some of them are small amounts, some of them are much larger. But my message to Jennifer or any issuer, if a couple of those investors left, we wouldn't have to get rid of your transaction. We're not reliant on 6 or 7 investors that are the majority of our assets. So it's a lot more from an investor relations standpoint. It's a little more work to talk to 150 people, but it creates stability, and so from that standpoint, we can be more of a consistent receiver of risk from the issuers. That's also beneficial when a deal is struggling a little bit. I think we're approaching $4.5 billion. We can easily do $100 million requests for allocations. That's a meaningful position in the market, and occasionally you can leverage that depending on what the market conditions are. So from that standpoint, I think investors are still drawn to this. The cat bond space, and by the way, at least with Pillar Capital, yes, it's more private reinsurance. We do have hundreds of millions of dollars of cat bonds in our portfolio. So we are a kind of relative value multi-strat player where we're playing reinsurance, retro, ILWs, and catastrophe bonds. It all depends on what each subsection is doing. So we try to at least offer investors, the margin compression in cat bonds has been greater than other parts of the market over the last year, and maybe that will reverse itself. But in general, we will move capital from one place to the other. I think from that standpoint, investors are drawn to something like that as opposed to a specific, this is a cat bond fund, or this is an ILW fund, or this is a retro fund. Sometimes they're moving in different directions, and if your specialty is having margin compression significant, you got nowhere else to go. So from that standpoint, I think offering a bunch of different options to investors can increase demand, but you still need to get into the weeds and explain to these people that, bad hurricanes happened 150 years ago and nobody talked about climate change then. It's not necessarily a new phenomenon, although it's clearly impacting wildfire for sure. But that's a relatively small part of the expected loss across the industry, whether it be cat bonds or private reinsurance. So kind of like what I said before, I think the interest is high, and what's happening in other areas is helpful to that. You still need to do the work and get the education across, and that takes months. It doesn't happen right away. So
Yeah, I imagine if you're getting on for hundreds of investors, your time is very much significantly spent in the education phase with them. It's a really important piece of the puzzle for this asset class still today, even after 25 plus years. Paul, more broadly within the Aon Reinsurance Solutions world, perhaps you could talk a little about how the wider range of use cases for capital markets capacity are playing into servicing your clients there, and highlight any interesting trends you're seeing for us.
Yeah, sure. Again, kind of easier to have these conversations, but if we just look at the cap on market as a way to start the conversation, we compare 25 to 24. We're up roughly 20% in terms of notional. We're actually up about the same percentage in terms of average deal size. And then, as Jennifer noted, and Anne was certainly very privileged to work with her. We've done large deals as well. So a couple of deals that are $1.5 billion plus, a couple of deals just under $1 billion. And so what we're finding is that the range of potential solutions is now broadening to the point where we can have maximum impact across a lot of different client bases. And whether that's the traditional insurers or whether that's reinsurers, whether it's some of the government-based activity that we've seen across the geography, whether it's still for corporates and we still have a sort of a wish list that we kind of grow that market as well. I think we can come in and have a range of conversations about a wide range of potential outcomes across, again, bonds and private ILS, and really have a meaningful impact to the conversation. And as an example, for U.S. nationwide, or maybe even want to make a global sort of nationwide personal lines companies, we're seeing cat bonds now represent, as much as 30% of the risk transfer. Again, getting back to the word foundational, we have moved from a transactional-based market into something that feels a bit more like, it's not exactly like, and it never should be exactly like traditional reinsurance. But what is important to reinsurance buyers and retro buyers is consistency. And so what we're doing is we're now moving into a point where you really don't hear questions, will this market be around post-loss? You really don't sort of hear that. Although I did hear that the other day, that there are still a few skeptics out there, so we haven't convinced everybody that this is a long-term market. But rather than sort of trying to spend half of your conversation around why this market will be durable and sustainable, why it will be around in 10 and 20 years, which we certainly have had to do over our career, now it's all about sort of what type of bespoke solutions can we create. And here the capital markets tend to be a bit more innovative, flexible around the types of products that can come into it. So not only do we have the scope to do small transactions to large deals across insurance, retro, government, parametric, whatever all those may be, I think we can just talk to all of that, which just enables greater client solution, which allows us to put more types of products into the market for investors. And when we look at the investor side, cat bonds over the last 2 years have had the best returns historically that they've ever had. And so we're in a market where investors are getting paid well. That has also led to greater sidecar capacity, as an example. So we have different types of product solutions that in this market, for all the reasons that all the folks have talked about, are just very interesting to both sides of the trade, so to speak. And that's enabling transactions, which then, as we talk about the wide range of potential uses, casualty is right up there. So we're seeing a greater interest on casualty ILS types of deals. We saw a bit of flurry in cyber, and then it went a little quiet. But cyber, that risk is certainly not decreasing in this world. That the risk is only increasing. It's only a matter of time. It's inevitable that part of this market grows. Casualty, I think will grow as well, but we're certainly still in the green shoots part of that marketplace. And so today, Aon has the privilege of being where we are in the market. We have lots of things to talk about with our clients, lots of different types of products and solutions, can create more customized, bespoke answers for clients, which will inevitably lead to greater usage and deployment and opportunity going forward.
No, that's really good to hear. It does feel like now the bond product and other collateralized products are really part of a cedent or a sponsor's thinking upfront when they're beginning to think about their next renewal needs, rather than it being something that's an add-on or a small sliver, as you say, which is really positive to hear. So I'd like to move on and talk a bit about the sort of current trading environment at the midpoint of the year, and obviously very important reinsurance renewals in Florida just done, and the July 1st with US and some international treaties as well. So it's a very active time, and the cat bond market just continues to flow. Steve, let's turn to you first this time. So you spoke about investor appetites before, but perhaps you could give our audience a little insight into trading conditions for you at these renewals, how this has been from the perspective of an ILS and reinsurance fund manager, and are you pleased with the access to business you've had this year and the portfolio construction?
I mean, for us, we have pretty good deal flow, so there really isn't any complaints there. I think investors are a lot more in tune to what's going on with pricing, and if you back up to 13 to 17, pricing was going down 10 to 20% a year, but there really weren't any events, so people were still making a 8, 12, 14% return, and then pricing really descended to a place that was untenable over the long run. And then you had 17 and 18, which were clearly above average years, but they weren't the big. It clearly was. There'll be bigger events out there, but the pricing was some of the lowest I had seen in my career. So from that standpoint, the end result was pretty ugly. So fast forward to today, even though the market's off a little bit from 2 years ago, it's still in a pretty good place. There's no reason for investors to back away. I mean, 200 basis points better expected return last year or the year before is better than not having that. But in general, the margins are still good. There's been some compression, certainly on non-loss impacted transactions, at least in the private reinsurance area. What we've seen with cat bonds, margin compression is a bit greater in the cat bond space. There's more issuers. They're positioning those bonds up in the senior tranches of the program, and then that is either eliminating the private reinsurance or forcing pricing down to match the cat bond the cat bond pricing. So down at the lower end of the program, cat bonds aren't positioned down there. That's certainly been where there's been some events or some losses. And at least with the wildfire, I mean, I think the companies that suffered wildfire losses paid appropriate price increases. The market reacted the way it should. Fast forward to Florida, with the fires, everyone's forgotten about Helene and Milton already. And but down at the bottoms of programs, a little bit of price increase there. Up at the top was a price decrease. So all in all, the market is kind of moving sideways to down slightly. But it's starting from a position that's quite good, and the position that will end up in on July 1st is also going to be quite good. So there's been no significant complaints. I mean, every underwriter thinks they should get a little bit more premium, and every buyer thinks they paid too much. So putting those biases to the side, I think we're in a good spot. But investors are keen to know what's going on. They're not going to sit there and let pricing go down 10 to 20% a year over multiple years and do nothing. They are going to leave. They are going to redeem. They are going to pull out of cat bond funds or private ILS funds. So that's a good thing, because if investors actually did that from 13 to 17, pricing probably wouldn't have gone down as much as it did. So from that standpoint, I think the education level is much, much higher, and there's more of a self-regulation in the market, especially with some of the bigger rated carriers. I think there's a lot more supervision, executive supervision. Back in 13 to 17, I think it might have been maybe not as much as it should have been. So I think all of that has gone to making the market much more healthy and much more consistent.
Mm. No, that's great. That's great to hear. Do you feel, as well as the consistency there on kind of on that side of things, do you think the fact that ILS is now much more embedded into towers will also help to maintain pricing a little more than before?
Yeah, I mean, as long as there are no big rated carrier startups. So assuming there's a series of significant events to really damage the capital base of the reinsurance market, you're probably not going to see, four more Validises start. That seems to be kind of over. A lot of that money can quickly flow into the ILS space. The problem with that is that the manager needed to have performed okay. Doesn't mean you had to make money, but if you were supposed to be down 2% and you're down 2%, you did nothing wrong. That's according to that's the proper outcome. If you're supposed to be down 2 and you're down 22, now maybe investors may not flow into those spaces, and that's kind of what happened in 17 and 18. So it all depends on performance and relative performance, and as long as it's justified, investors understand that when there's $100 billion hurricane, you're going to have a negative month, and you're not going to make much money that year. There's nothing wrong with that. It's when you have a couple $10 billion hurricanes and you have capital trapped for 4 years that just makes investors lose their mind. That's just not okay. And that's some of the things that the industry has really improved on over the last 4 or 5 years.
Yeah, and that's something the industry needs to continue to communicate to the investor base, is really those improvements as well. Great, thank you, Steve. So, Jennifer, going to move on to you and take your thoughts from the sponsor side. How's the rest of your reinsurance renewal outside of the cat bonds gone, and were you pleased with the outcome? And also, what sort of role you expect collateralized markets will play across your entire tower for this year?
So in our meetings with investors in both the capital market and the traditional markets, the takeaway was that there was ample capacity and cost-efficient price levels in both markets, but there were more advantageous conditions in the ILS market this year, which is why we ended up placing more than 52% of the 2.9 billion of the new risk transfer coverage in the capital markets. So we had 1.6 billion outstanding in prior year cat bonds from 23 and 24. And so if you add those in, the total cat bond coverage for our placement this year was 70% of our placement was in the cat bonds. So historically, the cat bond market, we have not had that large of a portion of our program. But considering that this year the cat bond market was such a better program, and it provided the aggregate multi-year, better pricing, flexible resets. We felt that we benefited from to secure the multi-year coverage at the higher levels. Typically, the cat bonds are less than 50% of our overall program, and this year they're 70. As far as collateral markets go, of course, all the ILS is collateralized, but on the traditional side, we only have a handful, 3 or 4 carriers, reinsurers that are collateral markets. However, their placement makes up 25% of the total traditional coverage that we have. So I prefer the collateralized coverage if that's what we can get. It's there. You don't have a problem. If a great big storm hits, you don't have to worry about whether or not reinsurers can, pay out to all their cedants. So the collateralized is always something that we like. But again, we only have about 3 or 4 of our 2025 participants that are actually collateralized, but they do make up a 1/4 of the whole traditional program.
Thanks, Jennifer. That's a really great way to drive home the importance of the capital markets for citizens, and also just how integrated it is with traditional reinsurance now for a buyer like yourselves. So moving on to Paul, it'd be interesting to hear your views on the relative importance of cat bonds compared to reinsurance at different areas of the tower, and whether you feel it's increased this year in the upper layers, and perhaps Jennifer is the perfect example there. And your thoughts as to how that dynamic might continue to evolve over time as well.
Yeah, it's certainly a dynamic answer, because it does change. It changes based on investor preferences, kind of the types of risk return that folks are looking for in the marketplace, just the overall dynamics in the marketplace in terms of premium levels and so forth. So it's pretty simple to understand that there's lots of inputs or lots of levers that go into that, and why that sort of changes on a year-over-year basis. But generally speaking, I think Steve addressed it pretty well. I mean, the cat bonds tend to sit towards the higher part of the towers, and the private ILS tends to sit, although it can be on the upper levels, tends to be on sort of the mid and lower layers of programs, and I think that dynamic is largely going to continue. Obviously, aggregate capacity being aside, because that plays across the tower and at different sort of risk return levels. But I think that actually fits going back to the foundational basis on the reason or the rationale or the thesis behind why this market was created in the beginning and in its inception, is that it was intended to be excess capacity for very severe types of events where the reinsurance market, albeit well capitalized, just is never going to be capitalized at levels that can sustain some of those concentrations, and the capital markets being a better place for that type of excess or sort of very kind of low probability type events happening, but when they do happen, to be quite severe. And so I think we're kind of getting back to the inception or the thesis way of thinking about it. And I think in a way that's been the driver behind the growth. For a while, I think we tried to do everything where cat bonds were across the tower, and we sort of got away from the original thesis. Now I think we're back to kind of why it was created, all the work that was done to sort of create this market. And I think to some degree that's why you're seeing the types of growth we're seeing, which is it sort of fits, right? The risk levels fit with the return levels, fit with what cedents want to accomplish in their risk transfer program. And so it feels like, even though it does change year over year, and by the way, what was the sweet spot of the cat bond market 5 years ago is not the sweet spot of the market today. So it does change. It does morph. It will be a dynamic answer. But all that being said, it's largely going to be still for the very severe low frequency type of events. And I think that as long as the market sticks to that, we can handle a little bit of spread movement one way or the other, because the return principle still holds. And what I will say, and I think this is true across all markets, traditional and non-traditional, is that addressing the retention issue was a very significant issue that had just been ignored probably for a bit too long, but kind of addressing something that should be a little bit more dynamic in the way it's addressed in all markets, I think does create just a more durable reinsurance or risk transfer product just generally. And I think as long as that holds, I mean, terms and conditions will change in different market cycles, but as long as that holds, that solves a lot of the issues that I think plagued us in those mid-teen years.
That's a really great point around attachments as well. It has been such an important change for the industry, and one that, as you say, will fluctuate over time, but hopefully we won't see it sort of deteriorate to the levels that were back in the 2013 to 17 era that Steve was talking about. So finally, for this round of questions, Michael, you said you're seeing good demand, but have you seen this increase for sort of reinsurance trusts to support these collateralized deals and cat bonds this year? With such a large amount of issuance on the cat bond side, I assume you're seeing some benefits from that. But have there been any other notable trends you've noticed this year?
Yeah, Steve, we've definitely seen an increase in the demand for those reinsurance trusts for both, cat bonds and non-cat bond coverage, and that's really correlated to how the market has increased over the past couple of years. We're also seeing a lot of increase in Canada for reinsurance coverage from existing clients looking to expand reinsurance coverage in Canada, as well as some new clients that are looking for that coverage as well. So it's been great to partner with our team up there, who are very well positioned to support those needs out of the Canadian market. Most of everything that we see does center around the property and casualty market. But as was mentioned earlier, we're also seeing an increase in trusts that are not tied to property and cat, but other risks as well. So it's been great to see, it become a much broader coverage than just the property and cat market.
That's good to hear about Canada, given we've seen a sort of Canadian sponsor come to the cat bond market this year, and hopefully we'll see a few more in that case. So just a reminder for our audience that you can leave us any questions in the Q&A box. If you have any, we will get to them at the end. So please, if you want to get a question in, please do so soon. So for our final round of questions, I want to go around our experts and get some thoughts into what the ILS market has done well so far this year. What, if anything, it could have been done to meet the market need, what more could have been done. But then also perhaps if each of you could give us your sort of outlook for the rest of the year as well, that would be great. Jennifer, I'm going to start with you, and perhaps you could share your thoughts on the effectiveness of the ILS market in 2025 and your hopes for how it can continue to deliver and support citizens into 2026 as well.
Great, thanks. So this transaction is our 13th issuance of cat bonds since we entered the market in the cat bond market in 2012. So over the last 14 years, the ILS market is it's an important risk transfer tool for citizens. It provides diversification, favorable terms, additional capacity, pricing tension for our overall program. But each year we do go out and evaluate market conditions in both markets and allocate our coverage based on what makes the most sense for the overall program, based on the terms and conditions, pricing, and capacity of each market. As Paul said, it's very dynamic, and each year it could be very different. Even though our book of business is shrinking due to the strengthening of the private market in Florida, the risk transfer will continue to be an important tool for us to reduce the probability and the amount of potential assessments in Florida. So this is definitely an important part of our risk transfer evaluation and our placement each year.
Great, thank you, Jennifer. Michael, on reflection, what's gone well this year in your eyes, and what's your outlook for the rest of the year for cat bonds and ILS, and where are you hoping to see more demand for your services coming from?
Given what we've seen so far this year, I definitely think we'll continue to see, an increase in the requests for, trust and support of both the collateralized and the cat bond space, and would love to see, the continued growth with our Canadian team and in the Canadian market. Just, one example of, the reinsurance space and the ILS space, broadening outside the U.S. So I think as long as, we continue to see liquidity in the market, support for growing issuance through, competitive pricing and investor appetite, we're going to continue to see both the cat bond and broader ILS market continue to expand.
Great, thank you. And yes, you mentioned the word liquidity, which I think is one that a lot of people are talking about, particularly with the market growing. I think liquidity becomes increasingly important, both for investors and for sponsors to know that capital is getting recycled efficiently too. Steve, turning to you, obviously mid-year renewal almost done for you and your team, and then also a period of consolidation and watchfulness during the hurricane season for most ILS fund managers like yourselves. But what are you pleased by in 2025 so far, and what's your hopes and outlook for the remainder of the year, and then obviously the next major renewal round in January?
Yeah, I think terms and conditions and discipline in the private reinsurance space has held up reasonably well. There's a little bit of price reduction, but I think it was mentioned earlier about some of the retentions, and a lot of the insurers want to buy down their retentions because of the secondary perils, and the reason they want to do that is they're not making any money on it, and then we don't want to take it because we're not going to make any money on it either. So from that standpoint, the retentions in reinsurance has really held steady along with most of the terms and conditions. So that's a positive, where again, you harken back to the 13 to 17 time period, and terms and conditions were deflating as quickly as price was. So it was a bit of a double whammy. So from that standpoint, it's good. I mean, obviously we're gonna sit and watch the Weather Channel for the next few months, but that just comes with the territory. And an investor kind of said to me, "Oh, does the hurricane season make you nervous?" I'm like, no, I should be nervous when I'm doing the deal, not when I'm watching the Weather Channel. Because if you structure things appropriately, you may not make money that month, but there shouldn't be significant issues with your portfolio. So from that standpoint, we don't get overly hung up on watching the forecast, and the forecast notoriously this early in the season has been less than 10% accurate. If you look at the accuracy statistics, when you get into August, the accuracy really shoots up. But by that time, the whole portfolio is done. Nobody's doing deals in September because it's the height of hurricane season. So I would say that, if there's more issuance available, that will help kind of soak up some of the excess capital, and issuance being private reinsurance layers and cat bond issuance as well. Construction inflation has probably been running about 7%. So you would think that reinsurance limits purchased would at a minimum grow at 7%. And so from that standpoint, if you can actually penetrate some of the uninsured, then the growth might be more like 10% or 11%, which is really where it falls to Aon and the major brokers to have those discussions. We're not on that line every single day. So from that standpoint, kind of closing the coverage gap and bringing more people into the fray is going to do nothing but make the industry stronger. So that's something that really falls to the major brokers, because they're talking to clients all the time. So that's kind of what we're looking for.
Great, thanks, Steve. Yeah, I think you're right. Inflation building on the coast, value at risk is going up all the time, isn't it? And there's certainly more uninsured value to cover as well. And turning to you, Paul, as the broker representative, perhaps you can speak a little more broadly about the use of diversified and efficient capital sources in reinsurance, and what have you been satisfied to see in 2025, and what are your hopes and outlook for the rest of the year?
Yeah. So I would just start by saying, as a broker, we try to be agnostic around the types of capital that provides the best outcomes for our clients, and I think a lot of the biases that we've lived through over the years have dissipated or are going away entirely. So I do feel like when we are presenting solutions for clients, it is literally sort of the best kind of use of capital and the best types of capital for that particular situation. We are seeing people, want to live in harm's way, and so I think we'll continue to see growth in the property market, personal lines. I think we'll continue to see just growth overall as just the levels of risk continue to increase, globally. And so I think it is actually a very interesting time to be in this market. I do feel like we'll continue to see profitable growth and reasonable cost risk transfer options for clients. I think the two can go hand in hand. We're quite bullish around the outlook for the rest of the year. We're quite bullish for the outlook over the next several years. And as we move into this foundational part of the market, to come back to that word, the market just builds on itself, right? So as we move away from a transactional based market where you don't know whether that will renew or not upon expiry, and as you move into a foundational market, you can take that growth rate on top of just inflation and other types of factors and really start to build a very interesting sort of case study around sort of where this asset class is going to be in the next couple of years, because I do think the future is quite dynamic and quite optimistic and quite bright for this marketplace. So all in all, we're quite bullish. We've had a number of record quarters in a row. We'll continue, I think, to sort of that we'll continue on that trend for a bit. And I think, again, all the pieces are coming together well at the right time to enable that type of view.
Great, thank you, Paul. Yes, we certainly had some record quarters, and I only looked yesterday that was it March, April, May, we're at over 11 billion of cat bonds that we'd tracked in that period, which is a really significant amount for a 3-month period. And I think, as you said earlier, Paul, they were numbers that we were looking at for annual issuance just 5 years or so ago. So it's really been incredible this year. So thank you all. That's our pre-prepared questions all done. We have got a few questions from the audience that we'll just try and rattle through a couple of them very quickly. And one of them that's a bit interesting, and I'll ask our panel just to raise their hands or speak up if they would like to answer this. But we saw the first issuance in Brazil under their ILS legislation just recently, and it was actually a surety bond risk securitization, so a little unusual compared to the traditional ILS market that we're more focused on in property cat. But I guess both on Brazil and their platform, do you have any hopes for seeing much more issuance from that? And do you think that's going to get some traction? And then what about surety bond risk? Is that something that is perhaps more opportunity for in the ILS space? I don't know, maybe most suitable for Paul or Steve.
Yeah, I mean, I would think of the surety area. Surety bond losses can be an economic issue. So if the economy kind of tanks and there's defaults, you have a loss. The non-correlation is probably more lacking in that type of bonds. It's the whole ILS. I mean, the whole casualty part. If you can expand into other lines of business, why wouldn't you do that? I think the valuation issue is an issue, and when casualty losses come through 3 to 7 years later, how do you have a 1 or 2 year fund that's investing in casualty? It's just the valuation is the key to that. So I would think that let's do more of those, but I don't know if there's going to be a lot of investor appetite, certainly for surety or casualty, because a lot of it's predicated on float and investment returns, and you're trying to get away from that here. At least that's the core marketing principle that we all espouse. So,
sure, yeah. Thanks, Steve. Paul, any thoughts on the Brazil platform from your point of view? Is that somewhere Aon would potentially service in future?
I think any types of risks that can come into the market from a portfolio construction perspective that are helpful for investors to continue to either create interesting outcomes for their client base or to create more U.S. capacity because there's diversifying risks into the portfolio. I think that's all viewed very positively, and to the extent we have those opportunities, we're going to continue to look to grow those. Obviously the modeling and the data and kind of all that stuff that goes into it is an integral part of all of those types of programs and risk solutions. But assuming you can tick the box on all that and bring a transaction that is priced competitively and earns an adequate return, given that you need to have collateral sort of underlying these solutions, then that's interesting. I do think, not that this is part of this conversation, but the growth of parametric products globally, even on a rated basis, on an insurance basis, I think may be a little better suited for some of these diversifying, global risks. We're seeing very significant growth in the parametric insurance market, and I would expect that growth rate to be exponential for a bit, just because it's starting from a smaller kind of base. But again, to get back to there's not one solution that fits everything, and these days you know, it's kind of shame on you if you're the advisor for not bringing up kind of all of the different product solutions that may exist in the marketplace. And some of that's collateralized, and some of it's just simply parametric on an insurance basis, and you can create some interesting outcomes for the capacity providers.
Great, thank you. I think that's a really good place that we'll maybe draw this to a close. And yeah, very interesting about parametric, and we certainly saw the comments coming out of Aon's Investor Day the other day about just how much that sector is growing. It's certainly an area that we'd like to see more flowing into cat bonds and ILS in general. Right, we're up on the hour, so I'm going to draw this to a close. Apologies to anyone whose question we didn't get to. So just wanted to say an enormous thank you to Computershare Corporate Trust for participating and partnering with us on this webinar. And thank you to our speakers, Paul Schultz, Jennifer Montero, Steve Velotti, and Michael Alfano. Great to see you all. Thanks for sharing your insights with our audience today. Really appreciate your time. And thank you to everyone who dialed in. Look forward to keeping you all abreast of developments, and we will be posting a video recap, and you'll also get an email to remind you can watch this on demand as well at some point in the future too. So thanks for tuning in today, and thanks again to all of our speakers. Great to see you all today.
Great. Thank you, Steve.
Thank you, Steve.